Hey, I'm Al. I'm the founder of Simply Wall Street. And in this video, you're going to learn everything you need to know about discounted cash flow. I feel fairly qualified to make this video because it was about 10 years ago that I wrote the original code that generates this number. And this discounted cash flow that we do is calculated every day for every single listed stock in the world. So we kind of know what we're talking about. I'm also confident that at the end of this video, 99% of the people watching are going to feel like they've unlocked a new skill. So we're going to go through a bit of the basics. It's not going to be an academic lesson. I'm not going to teach you how to do one. We're already doing it for you. And we're going to go through when you should use it, like when it's powerful, but also when it's not powerful. So when you shouldn't be making those mistakes. I'm going to show you how to use it to discover some companies that most people will miss. So how to use it as a really powerful discovery tool. And I'm then going to show you at the end a way of making decisions on stocks that doesn't necessarily use the DCF, uses ideas from it, and this is what I think is really going to unlock your investing. So I've got a bit of maintenance to do today on Jamil, which is a yacht that I bought a couple of years ago. She's a gaff schooner. She's wooden, which means she needs a lot of maintenance, a lot of TLC. First things first, let's see if the engine starts. Always a good thing. Let's give it a little go. Okay, let's give it a bit more. Let's give it a bit more gas. What do you reckon? Come on, here we go. Here we go. Come on. Okay, here we go. Forgot decompression lever. Okay, let's go. Whoa, 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 whoa. So what is a discounted cash flow? I'm not going to give you the full academic textbook example. If you want to do that, there's tons of resources online. But just to give you a really simple overview, discounted cash flow is simply where we forecast out cash flows into the future and then calculate them, what would be the value in today's money. And to turn it into today's money, there's really two main factors. The first is the risk-free rate. The risk-free rate is what is the guaranteed return I can get on money. So the best proxy for the risk-free rate is a high interest savings account. And then on top of that, you typically add a factor for the risk of the company or whatever you're valuing. So a more risky company, you would say, well, we're not so sure about these cash flows, so we're gonna further discount them. And that's pretty much it. That's how the discounted cash flow works. It's something that MBAs will go and study, but at its core, it's really straightforward. If you are interested, Simply Wall Street has the calculation on every stock. We are totally transparent about how we do it, but the point of this video is you should really not need to do that. Now, the input to the discounted cash flow is in the name. So cash flows, you're like, okay, that's easy, but then why is the market so obsessed with earnings? Well, the market adjusts its prices based on expectations of earnings, right? That's how the market works. But here's what a lot of people don't understand. In the long run, earnings and cash flows are the same. They're just different lenses on the same number. The simple way to think about it is cash flow is when the money is coming in and out of the account, and earnings is when it's being reported. A really simple example would be, I might send an invoice to a customer on a date, and that's when I report it in my earnings, but I might only get paid later on. This is obviously in the short term why the two can be radically different. The earnings and the cash flow can, for years and years, be completely disconnected. And we'll look through some examples of that. But in the long run, they're going to be the same thing. It is why, though, a lot of investors obsess over cash flows, especially more sophisticated ones, who've kind of realized that earnings are so easy to manipulate, especially in the short term, with lots of different things and write-offs and unusual items and all this stuff. And so cash flows are an easy one. But cash flows can also be very volatile. And that also makes a discounted cash flow hard, because really you're trying to get to the root of what do the future cash flows or earnings, same thing, of this business look like. Oh, pretty shallow here. Get away from this. Now, how does this work in Simply Wall Street? What we're doing at Simply Wall Street is we're taking the best available data that we can get on the cash flows. If we have analysts covering the company and those analysts have forecasts, we'll use that. Sometimes those forecasts will go out beyond 3 years. So if we have that data, we'll use it. A lot of companies don't have analysts covering them, but they still report cash flows. So then we'll use the historical reported cash flow data. And we also will blend the two together, right? So that it can be, a mixture if there's not much. And what we're doing at Simply Wall Street is imagine that we're taking the trajectory of the cash flows, whether it's historical or forecast, and then we're assuming that after 10 years, conservatively, that's going to kind of start to match the market, right? It can happen. Of course, there's a lot of great companies that can grow for high growth for many, many years, for longer than a decade, but actually the data shows it's pretty rare. And so again, conservatively, that will taper off. You can see that in the calculation. And where does this get tricky is where the cash flows are volatile. Why are the cash flows volatile at a company? They can be volatile either just historically, because especially on some businesses, they might have a bumper quarter, a bumper year, great cash flow at that point in time. But also if there's analysts covering the stock, especially on stocks where there's only a handful of analysts, then the forecast can also vary wildly. And let's look at some examples of when that can occur and why that can produce such extreme results. And this is always one of the questions that comes up about the Simply Wall Street number, is when we see companies that are 100% undervalued or something crazy, and you're like, how is that possible? Well, this is exactly what it's going to be. But it's also the reason that for a lot of larger companies, the discounted cash flow is basically spot on with the share price. It's not surprising, because that data is very available. And especially if there's analysts covering it, they've probably used the guidance of the company to come up with the cash flows. It's a predictable business, they know how it works. Here's the thing about this number. You're like, cool, that's so easy. Look, if it's undervalued, I buy the company. Why did I think investing was so hard? Like, this is the best thing ever. And that's a trap. That is a huge trap, and I'm going to explain that to you now. So I think there are times that we can use this number, and this number is super powerful, and we'll get to that after this. But the first thing I want to talk about is what I call magic internet numbers, and not necessarily magical in a good way. And really what I'm getting at here is this idea that just because there's you can find some number being spat out of a calculation that, this justifies the stock is undervalued, therefore I'm going to buy it. And this is really dangerous. And it's dangerous on a few different levels. One is trust. Like, can you actually trust the website or the app or whatever, or the report you're getting the number from? That's why in Simply Wall Street, we make the calculation transparent, and we're transparent about what the number is and isn't. It is not meant to be a number that says, I go buy it because of this. It's meant to be a number that is going to help you know, this stock looks interesting. This stock is worth me spending some time on to understand. And that's a really important difference, that it's not a blind following, like I'm buying. This is super interesting. Let's see if this company this company is actually undervalued. And just the simple way to think about it is, every day for every company in the world, we're basically saying, just purely looking based on cash flows, does the company look undervalued? But what's missing from the calculation, and what I'm going to explain later how you can factor this in, is the story. Like, we don't know the story behind these numbers because it's just not how it's been built. The story behind the numbers is what we need to talk about. And so I think that's one of the biggest mistakes I see people making. And be really careful, because there's lots of numbers out there. There's always a number you can find online that's going to make the stock look undervalued. And it gets worse. On other websites, what you'll see is, here's 10 different valuation methods or 10 different variations for discounted cash flow. And on these ones, it looks undervalued. That's not useful. That's just more numbers, right? More numbers, but they're dumb numbers. And so the reason that we just have this one number as part of our valuation analysis is that this is just looking at the cash flows and saying, hey, let's extrapolate these and see where this goes. It's undervalued, done. So that's really powerful, but don't make the mistake of blindly following it. Now, this is especially the case for smaller companies. Like I said earlier, those are the companies where they can have one analyst, and that analyst's forecast can change wildly, and that's when you're going to see these big numbers where their company's undervalued. To be clear, that doesn't mean it's not undervalued. It's not to say that it might not be interesting, but definitely that kind of idea which I see people fall into, which is, well, it's 90% undervalued. How can it go wrong? How could it possibly go wrong? So, like I said, this is a great number for, based on cash flows, how does the stock look? And now let's go into, how do I use that to discover stocks? Like, how do I use it in my discovery process? Because that's where Simply Wall Street can really help you. So what we can do is set up a screen, and the screen is just going to look for companies that are in that discount range. We can also add in other things there, which I would recommend, right? So you can add in, for example, I want the company to be undervalued. I want like not too much risk. That's typically a company when it's undervalued, it's typically riskier. That's always the investor's dilemma. So you can say, well, I want some risk. I want only a maximum amount of risk. Now remember, our risk analysis at Simply Wall Street is again looking at the fundamentals and the fundamental risks, not necessarily the qualitative risks, which we'll talk about in a bit, and how we handle that. So this is such an easy place to start. We set the screen up, and there'll be a lot of companies, almost be too many. So then I would recommend further refining it to something that suits your taste. Ideas could be balance sheet health, that could be one angle. Another one could be you want growth. Now remember, you don't need growth for the company to be undervalued. It's classic value investing. Actually, sometimes the companies might not be growing. A company can be high growth, it can be undervalued, it can be low growth, it can be undervalued. This idea of value and growth, it's really all the same thing. So we set up our screener, we save our screen, and once you save your screen, if you're on a paid plan, what's great is we're going to check every week if new companies match. So you don't really have to do anything. You just have to wait, and we'll email you when we find new companies that match that screen. And don't blindly buy them. That's not the idea. The idea is that these are interesting companies, and these are companies, this is an angle that a lot of investors are not looking at. So this is how you're often going to find companies that are not in the media, in the news, in whatever newsletter. And well, that's awesome. That's super exciting. And then we can dive in and see if it's interesting. Now you're saying, Al, you're telling me, okay, this number's great to discover companies and really quickly know based on cash flows is it undervalued, but you're telling me don't blindly follow it. Don't just go and buy that company. What should I do instead? This is why we created narratives. Narratives is a really powerful way to make decisions on stocks, and it's so easy. All you need to do is think about, what's the story behind this company? What's this company going to do? What's it going to do in the future? And we turn that into a forecast. We keep it really simple. You only have to forecast 3 things, and we do most of it for you. The first one is revenue. Where's revenue going? Where's revenue going to Like, where do you think it's going to get to? You can choose 3 years, 5 years, 10 years. And then profit margin. How profitable do you think this company is going to be? If you don't know, you can just assume that it will be as profitable as the industry or the peers it will be in. And then finally, what's the valuation? Like, how's the market going to value the company in the future, which is PE ratio. Again, if you don't know, safe bet would just be whatever people value, more mature companies in the industry. You only have to choose those 3 things, and it has to relate back to a story, but that story can be really quite simple. It could be, I think it's going to sell this many cars, therefore it's going to make this much money. And that then connects a story to a forecast, and that forecast turns into a fair value. That fair value could be exactly what we saw in the discounted cash flow, but the critical difference now is there's a story behind it and there's some kind of expectation. So once you've got your narrative and you've got your fair value, you can then assign it to a company, and if it's in your watch list, it's very simple. If the share price is cheaper than your fair value, why aren't you buying it? That means it's a time to buy. It's often what you'll find is you'll find a great company, but the price isn't quite right, and you're finding it hard to justify the valuation. Well, then you wait for it to, you wait for it to come down so you can start to say, now I think there's some upside. And if it's in your portfolio, it's the opposite, right? The fair value, it would be odd if you held a stock in your portfolio, but you didn't think that the fair value was, had some upside in it. Otherwise, why would you be holding it? And so a stock might hit one of your fair values, which, of course, when it happens, we're going to email you or give you a notification on. And then it's up to you to decide, well, I was right. Awesome. Nice one. You made some money. But now you have to decide what you want to do. Do you want to sell it, or do you want to review, and is there still some upside? That's why narratives is so powerful and so simple, and it's so good because it's so consistent. Most investors are extremely inconsistent in their decision making, extremely emotional, and they're not even thinking about forecasts and in this method. So it's going to be an absolute game changer. And it doesn't mean we don't use the discounted cash flow as an input, wow, this company's interesting. It just means we now have a reason why we bought the stock. Now, what I've just described might still sound like quite a bit of work, or you might be saying, I'm just not experienced enough. I don't understand these companies well enough to do that forecasting. Well, the great thing is with Simply Wall Street, the narratives is actually a community-based thing. And so we have thousands and thousands of narratives from our users on different stocks. It's very likely that at least if it's a popular stock, that we've already got a bunch of narratives on it, and you can choose and follow another user. So as long as you buy into their story about the company, you think, yeah, I agree with this, I think this makes sense, then you can just follow them, and they'll keep that up to date, and you can use that in your decision making. Of course, if you want to go create one yourself, it's just as easy, or you can copy someone else's. Now, we have made it possible, if you want, to set the discounted cash flow as your fair value. That's fine. If you want to do that, we're not going to stop you doing that. And but like I said, just keep in mind what that number is and what it isn't. I think as long as you're saying, yep, this is literally the value of the companies based on what Al taught me, based on the cash flows extrapolated, I'm going to follow that. There's nothing wrong with that. But the whole, one thing I want you to take away from this video is be aware of the limitations and know that there's no story behind that per se. Please, in the comments, I want to hear your questions. I want to hear any feedback, any other videos you'd like me to make, and I'll personally respond to every one of them. And thanks for watching.